Hello and welcome to the extensive weekend video, which is of course about stocks, gold, US dollar, bonds. I'll be talking Bitcoin as well, sectoral winners, and everything as it played out against the backdrop of Mideast escalations that some could and would be included correctly. Term it as on the path towards greater war. Here is the US dollar chart. I had been clear well before the onset of Friday that the two key indicators that I would be watching the most is US dollar and the oil price, and both had been offering pretty insightful clues. Compare just US dollar performance not only against the euro and the yen, which are the two most important currency pairs, however, do so against the Swiss franc, where you can see that those US dollar upswings lately had been running dramatically short of what this not trade-weighted US dollar index would show. It is quite clearly a sign, because we had seen notable dialing back in the tariff wars developing story. Let's call it like this. Here we go with the oil chart, and I had been terming oil as the one to rise, and I had issued that call towards clients, trading signals clients, well over 6 hours before Israel cut short those planned negotiations in Doha. And what else have we seen since then? I'll be summarizing these developments a few minutes later on. But here we go with the oil chart, and what's notable here is that on this hourly chart we see no meaningful retreat in oil price, and we had seen quite a move in the US dollar as well, which is painting the same kind of picture. Note that whenever it seems that Israel is winning, is having the upper hand, US dollar tends to rise. However, we have seen quite a few insightful local nights in the Mideast, which had, to put it shortly, quite turned the picture, and you will hear me comment on that most briefly in the following parts of this video, and of course in way more detail towards clients. You see that gold is as well not at all losing altitude, and it's expecting the same kind of development that I'm expecting as regards the Mideast, and frankly it will be quite right, because this is a most brief development summed up tweet that I made regarding the second night of Iranian counterstrikes, and thus far the Hormuz Strait is still open. Imagine what oil price would do should it get closed, and most notably what it would take to get US into the war directly, even more directly. We had seen focus shift from low CPI, which had powered stocks higher, and they could not keep those gains, off to the recovery based on inline PPI figures. However, already on Thursday, this is the macro part of this presentation, already on Thursday I had been talking about the underestimated importance of continuing claims rising way more over 1930, which was the level that I gave to clients before the data release as the one that has the potential to start causing trouble. However, markets sailed past and ignored that. The same goes for the ADP employment change earlier, which is the employment tally and job creation potential within the companies of less than 30 employees. However, the headline figure was fine. We had seen, however, as well downward revisions for prior 2 months, which had not been, and it is still calling into question the strength of the consumer. And as I had been saying on and off for well over a week, I'm referring to the last premium mention that I made about that aspect, is the bifurcation of the retail market. Several retailers are doing well, and then you have garbage cases that are declining, that are not able to catch a solid bit. And I'm not talking about just Abercrombie or Lululemon. We had seen, and this was my point midweek, that the rate cut odds starting with the month of September had gone meaningfully up. I don't expect the Fed to move this easily. However, what we are seeing is a certain dynamic that I will illustrate further on with charts. And that goes for the bond market, and not just the yields, but performance of various bond market instruments, whether treasuries or corporate. S&P 500 breadth signals as viewed through the lens of stocks trading above various periods of their moving averages, and performance and clues that we can gather from the performance of S&P 500 sectors on a medium-term basis, meaning accounting for more than a 5-day performance, accounting for all the tariff wars preceding ones. And Friday's presentation and Friday's upswing in equities was clearly, I clearly interpreted as markets discounting an Israeli win, and I had been making the case to clients that the more time passes without a serious Iranian response, the more markets would be willing to take it as not just a first decapitation strike success by Israel, meaning not just a tactical victory, but a strategic victory. As I talked with one of the more active clients on Telegram one-on-one, it's that Iran is of course way stronger than Syria was. However, they had been restraining their ability to respond, which was clearly seen as well in autumn last year, where they could have inflicted serious damage, but they chose not to. They were faithfully following the negotiating path. And then we have the Trump tweet of threatening consequences about hardliners talking a good shop, but being dead right now. We have Muhammad will bin Salman statement about Israel doing everything it can to get America to war, and Blackman's direct calls for US to take an active military part. And of course I had tweeted as well the official Israeli request to the US to participate in those strikes on Iran. And I think it's painfully obvious if you look at the history of last 50 years which way the US would ultimately decide. But here we go with the market breadth perspective. At the close before Israeli strike that had cut short those negotiations that were supposed to take place this Sunday in Oman. But frankly, who is there to negotiate with when the leadership had been killed? Now we have had reasonably sideways looking constellation within S&P 500 sectors, with the short term still looking relatively okay, and everything had been just a matter of assessing whether the Israeli strike elicits a meaningful response and does so very fast. When that response did not come within a couple of hours, and those initial 100 drones that I talked about in Friday's video had been just the most opening round to deplete the defenses, at least somewhat. Then we had seen a meaningful retracement in S&P 500 prices, and as well in various other risk metrics that I will be diving into in this video. However, following the close and the clear notion that Iran is very well capable of responding forcefully and hitting as well where it hurts, then we had seen a risk of turn where of course Just Energy had been the great performing S&P 500 sector, and we know that based on energy performance there is no S&P 500 bullish run can be sustained. However, is this a marked for good turnaround to the downside? Further proofs are what the comparison of stocks trading above various periods of their moving averages are. This is what gives a more clear answer. And for now, with the veracity of Iranian response and how I read the Israeli media and statements and what it does with the United States, and what would be the actual path and possibilities to get the United States to participate forcefully in the conflict. That's a bit what the markets themselves are right now presaging with their technical posture. Note the steep deterioration in the percentage of stocks trading above 20-day moving average. Thus far, it had not caught up dramatically with those trading above the 50 or 100 or 200 days. However, we are on the verge of very well along that route to lose the 50 line in the percentage of stocks trading on the 200-day moving average. And what had been macroeconomically slated to be a bullish case was smothered in the Mideast flames, and it's my contention that this conflict will be exceptional, and we are still not through the greatest escalation that is slated to happen, but there is very high odds of happening, no matter how much restraint Iran had been showing within the weeks and within the days and everything that led to this situation that we are facing, that strategic resolve, that patience, that is what we are facing right now, leading to more forceful continuation. I will be discussing that further on with clients. But here we go with the technical deterioration, and there are as well signs, but I would not be examining them on the per sectoral basis, but I will today put it into context of longer time series performance of key sectors. For now, it can be said that short-dated bonds are keeping their relative appeal, and you can see that ever since the tariff escalation, there has been a rush to short-dated bonds. Meaning, if I compare that on, say, 1 to 3 year aggregate, which I use often, you can look at SHY, compare that to TLT or TLH, but even on this chart, it shows quite stable spread and risk aversion when the 10 to 2 year are being examined. When it comes to bonds, we had till geopolitics took over a distinct preference for corporate bonds, turning to selectivity even within that sector. But for now, we are seeing them being dragged on through Friday's appreciation, that no matter what kind of gloating on the highest levels of world power this Israeli strike brought about, we had seen, and we are seeing the realization that this was, from the Israeli perspective, an overly optimistic assessment. And this is seen in the high-yield corporate bonds, which had clearly followed to the downside. They are not leading to the downside, but similarly to the percentage of stocks trading above the 20-day and maybe even a bit longer or shorter. 20 is what I'm watching most often. You can as well find value in looking at 5 or 10-day moving averages and percentage of stocks that trade above these. then it can be safely stated that this market is following Friday's session nervous about what can turn out of this configuration, and whether we had seen the worst of it or not really yet. I'm not in the second camp once again, but keeping it within the stock market focus, which this following chart is about, I have drawn a few supports turned resistances that I had been mentioning lately, for example in the preceding week's videos or articles this week, where I had been in the free opening parts bringing up a chart that had featured a few of these. So which are the levels that had been most valuable when it comes to interpreting stock market action lately? Yes, 6,035, and on the PPI driven jump higher, which had completely brushed off the weakening consumer and the job market worries, we had seen that, as I have said to clients, that the 6,050 area would present an obstacle to go to the upside, and you can most clearly see with those two prominent red candles starting Friday overnight from the European perspective, meaning 6 hours before New York. Then it's the time when Israel did strike, and the more time had passed before Iranian response, the more had equities retraced to the upside. They had overcome the second important level, which is here drawn as 6,006. However, they had struggled at 6,035 again. They had not been able to overcome Thursday's highs, and when the first round of Iranian response, the first night of Iranian response had arrived, the markets started appreciating that this would take longer, and we had seen as well those gleeful statements being walked back with the subsequent ones, including denying US involvement, knowledge, responsibility, however you call it. We had seen as well a certain willingness to buy into the close, and it's my contention that the risks had been and are skewed still a bit to the downside, because the Iran had been written off way too fast, and it's for all the success about liquidation and the initial round of strikes, it's still a mighty power able to inflict serious damage, and this corresponds with where I saw the support, the key level in 5.9. 70s with the ultimate one 5965 drawn to the downside, which had not been seriously messed with. However, could we still break lower? If I look at how the first weekend night, the night before Sunday's Globex Open went, then there is serious potential to break this level to the downside. And I mean that a certain sector, meaning financials, is leading me to lean this way based purely on the stock market internals and not just on reading of the geopolitical situation and how it stands, not just at the moment, but crucially what the prospects for next week's restless week where these lie. And here we go with financials. They were supposed to be in a good position to suffer the most kind of shallow correction, and the fact that they had picked direction clearly to the downside, while it's not the kind of a gap that smacks of early April run up to liberation. The fact that it's different and more tame does not look anyway that this is the bottom one, because frankly, where following this weekend what a source of calm when the Fed is not willing to cut, where would it just come from? Very valid questions. So, financials are not doing great, and what had been the great clue about last week, and especially its close, had been Russell 2000 and KRE doing their bit in the run-up to CPI. But that was the time when macro was in the driver's seat. Now it's more even, and yet I can still see that markets are turning and correctly interpreting the current balance of risk and how it's perceiving the conflict to be unfolding within currencies, within bonds, and within sectoral performance. And now the picture between purely relying on macro and fundamental reading of the situation, for example, how well oracles and let's call it safety state, how these plays, and I mean they're including Palantir and all the data centers plays, electricity, BSD, and so on, how these had been going. We can clearly draw a story, and that is a very different performance when it comes to viewing, for example, consumer discretionaries. So within the stock market, we are seeing, if I were to pick three sectors that would do great, it would be over the medium term. It would be which would be leading. It would be tech. It would be, in spite of this chart, it would be financials, and I'm still confident that industrials will see their good times again. But here we go with discretionaries that are just unable to break higher, and note how much below their late year highs, when the focus was on deregulation and upcoming Doge drive, and you know how this went. But the slide had been holding up nicely in the late in the week turmoil, hasn't it? We see that discretionaries are quite lagging, and these are correctly interpreting the mispriced risk of weakening job market. It does not matter for as long as it starts mattering, and we are still not yet at that stage. So that's why markets have been able to brush off their post CPI sell-off and rise through continuing claims, and in general the initial ones are slowly trending higher, and I had already talked the downward revisions in job creation, and even if jobs and challenge job cuts are painting a more cautious, a better picture in the job market, cautious in the sense of the word that it's no outright panic, that ties up nicely with XLY not making any kind of an upside progress. So this sector is stunned and unlikely to be leading, given where the economy and the status of the job market is. Used car prices and delinquencies, I had talked all of these in prior extensive videos or articles for clients. And here we go with the sector that would be among my top 3 picks, and that is industrials. And for all the Mideast bloodshed that had been going on for so long, this sector is clearly painting the picture of no recession on the table. Tariff wars had been dialed back, and these had been a way greater threat than Mideast is. Or one more thought regarding the US dollar. Typically these two are having a different kind of relationship than the inverse one, and you know that I have been pointing out the importance of 100 to 101 USDX zone, which had clearly been rejected, and US dollar is in a downtrend, and it's heading considerably lower. Will it still stay in the 90s? Oh yeah, yes, it will. It will stay above the 90 level, but it is in a serious downtrend, and the current Mideast developments are not playing into US dollar strength, and that's about it. When it comes to tech performance, I had been highlighting the relative upswing in the tech to SPY ratio, which will be apparent from the following chart, and it is one that is clearly being shown in the tech to semiconductors. Of course, there is the segment of AI semiconductors, which had been doing notably better. But you see that these had taken a turn to the downside as well. However, this is still within the context of extreme headline sensitivity, extreme sensitivity to perceptions of the impact and trajectory of the Middle East conflict. How many world players will get sucked in. Note the no prominence of Russia and China in the conflict. This is about the uncertainty which would define the further path. For now, the optimism and the macro focus had been dialed back, and as you can see, not even those great oracle earnings had been able to keep tech elevated. But still, this would be the sector which I would be looking towards to lead S&P 500 higher out of the current wild gyration that is not yet played out, because what was shaping to be a shallow correction where focus following the post CPI sell-off would be worked off in a very shallow way, had turned into more of a tail risk, and this is the chart which just goes to show that tech is in no way falling apart relative to S&P 500, and this sense still within the current extreme uncertainty and very quick gyrations in risk perception. This is still not falling apart, and tech is still slated to lead S&P 500 out of the current potentially more precarious move lower, more precarious as in it's not yet done, and the sense of complacency from Friday over the lack of meaningful Iranian response, because frankly those Friday morning hours drone strikes had been way less than the Iranian history of last year had taught Middle East and market players around the world raising money to work have taught them to expect, and this had led to underappreciation of what Iran is still capable of doing. And take that within the context of tech not falling apart, and this is sending a meaningful signal as to, no matter the turbulences to come, which way S&P 500 is willing to go next. My joint page will help you solve what's right for you based on what and how you trade. Make sure to combine the daily analytics with the intraday channels and make great use of the one-on-ones.